Hey everyone, welcome to the show. I'm your host, Bryan Kuderna. And just a quick PSA, if you're new to the podcast, typically I'm interviewing all different folks from different walks of life that can teach us about wealth in its original meaning, a state of well-being. Could be authors, athletes, leaders in business, and so forth. Definitely go back and check out some episodes. But every once in a while, I put on my financial advisor hat and just chime in with a quick segment, kind of a financial update. As we know, money impacts everything, and this is going to be one of those episodes. So you'll be hearing just from me. And as I'm recording this, which is March 14th of 2025, we obviously have a lot to talk about in the markets and in economics. So I think we just want to get a quick update, bring everybody up to speed, some things to think about as we kind of close up the first quarter of this year. If you could believe it, time just keeps on flying by. And with that said, I just want to remind everyone, wherever you're listening or watching, don't forget to subscribe and like the show. That's the way we keep on growing the audience, sharing some of this wisdom, and getting those really cool guests here on the program. So with all of that said, what am I going to be talking about today? So certainly Trump's tariffs, among many other things. I would say that the tariffs are front and center right now. You're hearing new headlines every day. And the fact of the matter is it's having a big impact on the stock market. So we're going to talk about that. And one thing that I do want to share, it's one of the most famous disclaimers in our industry, is that past performance cannot predict future outcomes. So you want to bear that in mind. But with that said, when investors are out there saying, well, where can I find a frame of reference? Is there something that I can compare what we're going through right now to perhaps some different things that occurred in history? And can I at least get some sense of how I should feel about this or how I should interpret both the news and the data? All right, that's common sense. I think that's what most investors want to do. It's human nature to always be seeking patterns. It gives us a sense of comfort. Now, I will say the stock market does not really have patterns. It can be very fickle, but it does react to things that go on in the economy, in politics, in both monetary and fiscal policy. And so I think if we just have an understanding of some of the cause and effect, that can, if for nothing else, make us a more confident or a more rational investor. And I think that's a good investor. I always tell people the worst investor is an emotional investor. That's someone that doesn't pay mind to the markets. Then all of a sudden they catch something on the nightly news. They either get really excited or they get really nervous. And then the next morning they make a change to their portfolio or they call up their broker wanting to do X, Y, or Z. That type of immediate reactionary trading is usually not wise. Okay. Oftentimes that has an unhappy ending. So that's going to be the purpose of today's episode, give you a quick update of where we are here in the first quarter of 2025. And the good thing here, kind of the teaser, is we have a lot of like variables that we can go back and make a comparison to. In particular, we're sitting here with a new president in office who we've already experienced. We already have a Trump 1.0 that we can go back and look at. Now, I often tell clients and investors, you don't want to mix politics and financial planning. You don't want to mix politics and investment strategy. But the fact of the matter is there can be some correlation here. And again, at least we do have something to go back and look at and say, hey, we've seen this administration before. We have seen this president before. We have seen some of these things before, and the impact or the non-impact and sometimes that it has on the stock market. So I know that was a quite an intro there. I hope you kept up. We're going to share a lot of really cool data today, and hopefully you can keep up. If you have to go back and listen to this one twice, I will keep it brief. We're going to hit the key points. So this is probably going to be about a 30-minute episode. So if you want to replay it and go and hit, maybe the speed up thing where you can listen to me talk twice as fast, go ahead and do that. Whatever you got to do to absorb this data. But without further ado, here we go.
Is going to require work and time and sweat and toil. If money wasn't an issue, what would I be doing?
Don't worry about it. You'll figure it out.
Change is the only constant.
The Kuderna Podcast.
All right, so what are we looking at right now, March 14th, 2025? As we all know, the stock market right now is in one of its worst runs in recent memory. Now, I say recent memory, I want to underscore that. If we look at context and history, not all that bad. But right now, where we've gotten used to markets, bull markets that just keep going up and up, this can definitely feel a little off-putting to investors out there. All right, so as I'm recording this, the S&P 500 is down roughly 5% year to date. Nothing crazy, but that's a negative. We don't like red. And the bulk of that has happened just in the past couple of weeks, of course, with the tariff talk really ramping up. Over the past month, the S&P 500 is down about 10%. Okay, so we could be approaching correction territory in various sectors. But the thing to note that pullback, that 10% pullback I just referenced, that is off of a record high. So again, we want to keep things in context here. Now, as I just mentioned, we're in the middle of this downturn in the markets. That probably raised a question. Well, Mr. Financial Advisor, Mr. Economist, are we in the middle, or is this the beginning, or is it the end of a downturn? That's the million-dollar question that, of course, everybody is asking. So remember, when we look at things in the markets, it's a snapshot of a point in time, okay? If you look at a downturn and all we're looking at is the past month, the markets are absolutely awful. If we're looking over the past 2 years and just this recent pullback, we're still experiencing great returns in the markets after 2023 and 2024. So again, we got to keep this kind of reference point of what snapshot are we looking at? Is it month by month, year by year, or over economic cycles of perhaps 3 to 5 years? So like I mentioned in our intro, past performance will not always indicate future outcomes. We've got to keep that in mind. But if we're going to do a comparison here, let's do it. And we do have a lot of similar variables that we can work off of. So to look at it from a bit of a political standpoint and how that's affecting the economy, what's similar? Well, first off, we have a Republican administration following a Democrat administration. Okay, if we want to look at Trump 1.0, Trump 2.0, previously he was following up Obama. This time he's following up Biden. Okay, so for whatever that's worth, we have that context. The biggest thing, of course, is the Republican administration is the same one. We have Donald Trump in the White House. All right, just quick trivia. That's only happened one time before in history that we had a non-consecutive president. I'll let you guys guess if you're sitting with a friend who that is, and it is Grover Cleveland. Okay, so Donald Trump is the second time this has occurred. But let's look at Trump 1.0 to set the stage, and then we'll bring it up to today. All right, so remember, Donald Trump first took office in 2017. That's when he assumed the White House. And let's look at some key economic figures at that time. All right, following up, as soon as he walked into office, 2016, the CPI, the Consumer Price Index, that's the most popular gauge of inflation. For the year 2016, it was 2.1%. Okay. And then, of course, immediately in 2017 is when Trump assumed office. All right. So he was coming in with a CPI of about 2.1%, which, by the way, is right at the Fed's target rate of 2%. Now, the federal funds rate. Okay. So this is, if you hear about the Fed and Jerome Powell, I'm sure we've all seen him in the news since the fight in inflation and the huge rate hikes in 2022 and what that could do to the stock market, and then inflation getting back under control, which we'll talk about in a moment. All right. In 2017, when Donald Trump first took office, the Fed funds rate was 0.5% to 0.75%. All right. Obviously, that was a very, very low level. And what that means is that banks can lend one another. Okay, that's the overnight lending rate that banks would charge each other, which is then passed on to consumers and the whole economy, was extremely low. So that's almost where people say, hey, there's free money floating out there being lent at extremely low interest rates. And so that just gives a huge influx of capital and liquidity into the economy, which is a boost. That's a huge boom for the stock market. Okay. So again, just to recap two of those huge benchmarks there, Trump came into office 2017, inflation 2.1%, Fed funds rate, the range was 0.5 to 0.75. Okay. Now, how did the stock market do right before Trump came into office? So in Obama's last year in the White House, pretty good. The S&P 500 in 2016 posted a gain of 9.54%, okay, which is a little bit above average historically. So nothing crazy, but it was certainly, he was entering the White House on good footing by most economic benchmarks, okay? Then if we switch gears and we look at the non-financials, okay, so when Donald Trump comes into office, what happens? Just to refresh everyone's memory, I know 8 years ago could seem like a lifetime, and we forget a lot of this, but when he came into office, one of the first things he did, he signed an immigration ban. Okay, you remember Build the Wall was one of his campaign promises in the first go-round. He immediately exited the Paris Climate Agreement. So again, a lot of this seems familiar as I mentioned it. He was looking to other countries to say, now you need to step up and put more in. And America is essentially stepping aside until you can figure it all out, was a lot of his rhetoric at the time. He started what was considered a war of words with North Korean leader Kim Jong-un. All right, that was something that was very volatile at the time. And then he wrapped up 2017, his first year in the White House, by signing the Tax Cuts and Jobs Act. Okay, that was one of the biggest moves of his whole presidency, and that did occur at the end of his first year in office, sweeping tax cuts across the field, both on the personal side and on the corporate side. Also, the U.S. military, if we look to that, remember at that time we were still involved in the war in Afghanistan. We were involved in conflicts in Iraq, and the U.S. had conducted airstrikes in Syria amidst their civil war. All right, so there was a lot of unrest in 2017 as well. So how did that first year of Trump 1.0 finish up? The S&P 500 was positive every month of the year except for March and August. All right, and the index finished 2017 positive 19.4%. Obviously an outstanding year in the stock market, and it was the best year at that point since 2013. Okay, so that was the first year in Trump's office. If you were an investor, all in all, you were very happy with the outcome. And as I mentioned, a lot of the economic factors of him stepping into office, positive, looking at inflation, low interest rates, following up kind of a average but good stock market year. And there was unrest around the globe, but nothing, I guess, earth-shattering, you would say. And most people would point to the biggest boom that year was his Tax Cuts and Jobs Act. And that was something he had talked about during his campaign throughout that first year. And then that came into effect at the end of 2017. So those factors all led to a very good year in the stock market. Now, if we go to Trump 2.0, okay, so now we're in the first year of his second term. Let's look at some of the economic benchmarks. All right, last year, the CPI, okay, the inflation rate was 3.0%. Okay, so pretty good. I mean, slightly higher than the Fed target rate and slightly higher than his first go round when he entered at 2.1%, but not a huge deal there. This is a big one, this next one. The Fed funds rate still sits at a range of 4.25 to 4.5. Obviously, that is significantly higher than the climate he entered in his first term when it was just at 0.5 to 0.75. So our interest rates are still much higher. Now, a caveat to that some people would point to as, well, that doesn't sound good, but is there a silver lining? The silver lining is when you're at rock bottom interest rates, there's really only one place for them to go, and that is up. Okay. And we saw that in 2022 and the damage that does. Now, when we're at 4.25 to 4.5, okay, historically a little more normal, they're definitely not low. That gives the Fed a lot of leeway to say, okay, if we have to go up, yes, we can. But ideally, with interest rates having been quite high in recent memory, inflation, that 3.0, remember that's coming down versus a couple of years ago. So the word on the street is at some point the Fed would likely be lowering rates before hiking them. That's a positive note. Okay, what about the stock market last year? Okay, so before Trump comes into office. All right, following Obama's last year in office, all right, Trump 1.0 was following up about a 9% return. Okay, now in Trump 2.0, following up Biden's last year in office, the S&P 500 last year returned 23.3%. All right, it was a great year in the stock market in 2024. And 2023, all right, was also a really good year. Remember, we're coming off of back-to-back 20% plus gains in the S&P 500. All right, so that raises another concern, were markets inflated? Okay, yes, there was AI, there was all this exciting stuff. Inflation was falling over the past 2 years. There were a lot of positives, but was 20% plus gains back-to-back years, was that too much? Was the market just overheated? That's what we're discussing right now. Then to switch, and let's look at the non-financials just to kind of tie in these global economic issues. All right, so Trump just came into office. What has he done? Once again, he's withdrawn from the Paris Climate Accord. Okay, he's begun aggressively the deportation of illegal immigrant criminals, okay, that have committed crimes here. He signed the Unleash American Energy Executive Order, ramped up border security again. He's working with Elon Musk on DOGE, the Department of Government Efficiency. Okay, that's something new that wasn't here the first time around. As far as a war of words, not with North Korea this time, but recently with Ukrainian President Vladimir Zelensky. We all saw that in the Oval Office, as he's trying to broker this peace deal, of course, with Ukraine and Russia. But that conflict persists, as does Israel-Palestine. So some things going on. I mean, we always talk about this chaos. Last time when he came in, it was Afghanistan, Iraq, Syria. This time when the president comes in, it's Russia, Ukraine, Israel-Palestine, amongst others. And then as far as the Trump Tax Cuts and Jobs Act, remember, when he came into office in 2017, that was a new thing. Okay, these were tax cuts. All right, the big difference this go round is that act is set to expire December 31st of this year. Trump is promising everyone they are going to extend the Tax Cuts and Jobs Act. But when you say, well, what would be the economic impact, or what would be the impact to the stock market? I think one point of observation is in his first term, these were tax cuts. In his second term, if he gets this extension, it is just that. It's an extension. It is not further tax cuts. In other words, if he does not get the extension, everyone will be recognizing tax increases. Okay, so there is that difference there that we do have to note. So what are kind of the glaring differences, not to use that word too much, but some of the glaring things that we might point out from Trump 1.0 to Trump 2.0 since we just set this stage? Number one are those tax cuts that I just alluded to. In the first year, the first year of the first term, he concluded with the creation of tax cuts. He is hoping to conclude in the first year of his second term simply an extension of those tax cuts. Okay. Again, if the extension doesn't happen, we all get to see tax hikes. Usually that would be a bad thing for the stock market. Number two, and this is the big one, of course, are tariffs. Okay. When Trump came into office in his first term, one of his calls to action was the tax cut. Okay. tariffs was kind of on the back burner. Those came about in 2018, which we're going to talk to in a minute. It's almost as if the economic agenda has kind of been flipped from his first term to second term. This year, tax cuts, or the extension, I should say, is not front and center. What's front and center are tariffs, and just unleashing tariffs and resetting the stage, kind of the world order right now, as far as how we trade with other countries. Okay, so it does look a little bit flipped. Are we going to see tariffs in year one and cut extension in year two? Whereas last go around, it was tax cuts right out the gates. And then year two is when we witness the tariffs. Okay, so knowing everything that I just laid out here, again, if you have to hit rewind, now's probably the time to do so if you just want that quick refresher. If you've kept up with me so far, you're saying, okay, you're comparing year one to year one, but what I think would be more realistic is compare Trump tariff 1.0 versus Trump tariff 2.0. All right, so let's do that. And to do so, we would be looking at what was his second year of his first term. Okay, that was in 2018 is when Trump set out this whole tariff agenda. So now what we're going to do is look at 2018, the tariff year, versus where we're going right now in 2025. So again, just to kind of recall memory, look back at history, in January of 2018, President Trump announced a 30% tariff on imported solar panels, which came almost entirely from China. Okay, that was kind of the shot across the bow. That was the first real thing we had heard about tariffs. And the first time we'd really seen this, publicly advertised and implemented kind of in such a large effect in a long, long time. Okay, since we've tried to have kind of this global free trade of the 21st century. Okay, so January 2018, he announces a 30% tariff on solar panels, a direct shot at China. So how did the month do? January was a really good month in 2018. The S&P 500 returned 5.2%. Now, keep in mind, while the stock market is a leading indicator, remember that January, which of course follows December is when the Tax Cuts and Jobs Act was signed into law. And it's probably more a result of that we had a really positive start to the year than the announcement of his first tariff. Because then you'll note both February and March of 2018 were negative in the stock market. Fast forward just a touch, April of that year. So as we enter the second quarter, April 2018, China says they're ready to retaliate. They slapped a 15% tax on U.S. fruits, nuts, wine, steel pipes, and some other goods, and a 25% tariff on U.S. pork and recycled aluminum. Okay. Trump immediately hit back the following day with a 25% tax on Chinese advanced science goods, such as those that are involved in aerospace and the medical industries. Okay, so as you could see, there was that first kind of shot in January. And then once we hit April of 2018, this is what people would refer to as like a full-on trade war between the US and China, hitting with higher taxes, some of those most important imports and exports. Now, China followed Trump's rebuttal with a 25% duty on aircraft, automobiles, and other imports from the U.S. Okay, so now the gloves were off, and this was becoming a bit of a tit for tat that was going on in 2018. By the end of that year, over $250 billion of Chinese goods were being tariffed by the U.S., and over $110 billion of U.S. goods were being tariffed by China. So there was no trade deal. That's what, they kept kind of, at least they were in communication talking about, can they hammer out a fair trade deal by the end of 2018? They did not. Okay, that did not come to fruition. So what exactly did the stock market look like, in that tariff year? Well, 5 of the 12 months in 2018 saw declines in the S&P 500. It was mostly alternating throughout the year, but the fourth quarter of the year saw the worst part of it all. And eventually 2018, the S&P 500 finished down negative 6.2%. Okay, so that was not a good year. It wasn't catastrophic, but minus 6.2 is something nobody was happy about then. And again, most of that happened in the fourth quarter, as I think people were hanging on most of the year, excited from the Tax Cuts and Jobs Act, and hoping that this would result in a trade deal that never came about. And then we saw, particularly in October and December of that year, the stock market fall pretty quickly. Okay. Now, something that's worth noting as you're trying to match up some of these different variables, that they may not be exact, but they certainly rhyme. They're very similar in a lot of regards. A lot of the players and the actors are the same. And you look at, well, what's next? Something worth noting is that all of these tariffs I just mentioned continued to stay in effect. It wasn't like a random one-off thing in 2018 and then they went away. They stayed in effect, and the Trump administration went even further during that first term, doing things such as banning the Chinese tech giant Huawei, hopefully I'm pronouncing that right, Huawei, in 2019 from buying any parts at all from the US. Okay. But in spite of those things, the stock market had outstanding returns in 2019 of 28.8%. And then in 2020, the COVID year, obviously took it on the chin in the first quarter, but then rallied most of the rest of that year to post a 16.2% return. All right. So just to recap, Trump comes in 2017, following a decent year in the stock market. Everything's going well. He has his Tax Cuts and Jobs Act. Really good year in the markets in 2017. 2018, the tariff year, we go down, negative 6%. Then things start to stabilize in a sense. 2019 was a banner year in the stock market. And then 2020, whole separate story with all the stimulus and everything with COVID. But again, another really good year in the stock market. So as we hone in on 2018 and say, well, we want to compare kind of tariff year to tariff year, you might be saying to yourself, was there anywhere to hide? Did anything do good that year? And the answer is kind of. All right. If we just look at sectors in the stock market, the best two sectors were utilities. Utilities was positive just a little bit, but at least it wasn't negative. And then healthcare. Healthcare had a decent return as well. Don't quote me on this, but I believe healthcare, according to most kind of analysis of the sector, was up about 6% in 2018. So maybe those are things to think about as we sit here in 2025 and we see, with Trump just unleashing tariffs left and right. So I just want to conclude this. I know whenever I do a monologue, there's a lot of information that goes into it. When we talk about global economics, there are countless factors that affect trade, the stock market, and all these different things. And we got to remember that the stock market is a leading economic indicator. Okay. What that means is as soon as information becomes available, it's instantaneously reflected in the stock market. Okay. That's what makes it so unique and sometimes so volatile. So bear that in mind when we talk about, hey, there's a tariff on China, there's a tariff on Mexico, we're pausing a tariff on Mexico, we're pausing a tariff on Canada. You can see as soon as the president or his staff comes out to say that, or he goes on Truth Social or X and says this is going to happen, the stock market can, reflect that immediately. Within the case of an hour, you could see a big swing in the stock market. All right. So a lot of this is dictated by investor sentiment and kind of what we're interpreting. All right. Now, there's not exact indicators from Trump 1.0 to Trump 2.0, but we've been through a lot of this before. A lot of it sounds familiar. Okay. You're seeing kind of the positive things of America first, pro-business, low tax agenda. We're expecting good things in the stock market for that. But we're also seeing from that negative vantage point of tariffs. And what I really want to underscore is simply the talk of tariffs and the impact that has on the stock market. Okay. And that, as a financial advisor and an economist, that is the frustrating thing. Is I can understand, and this is kind of my own soapbox, I can understand and appreciate the need for tariffs and kind of equalizing trade, both with friendly countries and some that are adversarial. But one thing that we know about Trump is the unpredictable factor. Okay. We don't know day to day, okay, are these tariffs going to stay? Is he going to pause them? Is he going to reduce them? Or is he going to double down on them? And that uncertainty is kind of what we're bearing witness to right now in March of 2025. And if we know anything as an investor, typically the stock markets do not like uncertainty. And I think that's, of course, why you're seeing so much choppiness right now in the markets is we want to see the tariff talk start to stabilize, okay? And that's kind of what we saw in 2019. 2018, there was this tit for tat with China, but then it kind of became a part of the economic climate, and we moved forward and the markets, did quite well thereafter. Right now, we are in the thick of it, and we don't know when that might stabilize this year, or is this something that could continue throughout Trump's second term? Only time can tell. We got to pay mind to all of this stuff and then recognize that that is just one piece of the pie. Okay. We got to keep our eyes on inflation, what the Fed thinks about inflation, unemployment, and then, of course, what this could all do to, the Tax Cuts and Jobs Act. That'll be another huge one that Trump is, at least what their staff is saying to the public is, yeah, there could be some short-term pain for a long-term gain in the stock market respective to tariffs. But later this year, again, remember I said the agenda seems flipped this time around. Later this year, or perhaps in 2026, is that when we're going to see some, favorable tax outcomes, which could be a boom to the market. I just want to remind everyone that all these observations that I've shared and these opinions, they are entirely mine. The podcast host, myself, Bryan Kuderna. Bear that in mind. If you want to go over your portfolio, your investment strategies, it is best to do so with your own professional advisor to discuss your own situation. None of this was meant as advice. And as I've said a few times, past performance cannot predict future outcomes, but at least we have a lot here that we can analyze. So I want to thank everyone for tuning in to another episode of the Kuderna podcast. I hope this gave you some food for thought. All of the data that I shared here, both from the S&P 500, comes from Yahoo Finance, and the Consumer Price Index and the Bureau of Labor Statistics, which you can look up this data yourself. It's always fun to follow if you kind of nerd out on economics. But I wish you well, and just pay mind to what's going on out there. But I would caution, don't pay too much mind. And again, what I always want to kind of underscore with that is it's good to be in the know, but you don't want to be emotional in the know. So I will leave you with that thought. Thank you. Keep tuning in, and we'll see you next time as we bring some really cool guests back here on the show. I'm Bryan Kuderna, signing off. Catch you next time.
This podcast is intended for the general public and for informational purposes only. The show does not provide any recommendations or investment advice regarding any specific account type, service, strategy, or product, or to otherwise act in any fiduciary or other capacity. Please contact a financial professional for guidance and information that is specific to your situation. Bryan Kuderna does not provide tax or legal advice. Please contact your accountant or legal advisor to discuss your situation. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Kuderna Financial Team, and opinions stated are their own. All investments contain risk and may lose value. Past performance is not a guarantee of future results. References to specific securities, asset classes, and financial markets are for illustrative purposes only and do not constitute a solicitation, offer, or recommendation to purchase or sell a security. Bryan Kuderna is a registered representative and financial advisor of Park Avenue Securities, LLC, PAS, OSJ 300 Broadacres Drive, Suite 175, Bloomfield, New Jersey, 07003. Phone number 973-244-4420. Securities products and advisory services offered through PAS, member FINRA SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Kuderna Financial Team is not an affiliate or subsidiary of PAS or Guardian. California Insurance License Number 0K04194.